We don't normally do VC analysis at NFX, but we think it's very important for founders to know what waters they're swimming in. Because venture capital has entered a definitive third stage of its evolution, and it's going to really affect how you interact with venture capital, how you fundraise, and how you scale your business. And so let's talk it through. The third phase is driven by the increasing scale of venture capital and how many venture capitalists there are, but also, of course, by AI and how AI is going to transform this industry. VC is growing and is going to continue to grow, which is really good news for founders, but it will have implications for you. It will benefit you by giving you even more funding options, and it's never been a better time to raise capital for your ideas. The first phase of venture capital was really between 1948 and 1994. It was really a cottage industry. There was less than 150 people even doing the activity. When I started as an associate at Battery Ventures in 1994 in Boston, there was about 40 active venture firms and a total of about 150 general partners. So 150 people getting a salary for deploying capital into private tech companies in the United States. That was it. It was a cottage industry. The investors were cautious, capital was scarce, people were very low key, they didn't want to be in the press, and founders would typically bootstrap their business to $1, $3, $8 million before ever raising venture capital. Venture capitalists could buy 30, 50, 60% of a company for $1, $2, $3 million. It was a completely different age. There wasn't a ton of status to it. Very few people knew the names of the folks, but you'd have a Don Valentine at a Sequoia, you'd have a Draper investing in things like Apple or Cisco. And VC 1.0 wasn't an industry, it was just a boutique club. It was a very small piece of the overall financial picture, and no one really talked about it. The second phase of venture capital really started with the advent of the browser in 1994. We had dial-up modems, we had desktops, we had a few laptops, but suddenly we had this browser which allowed you to innovate and invent new things for both consumers and for businesses that then lasted for at least the next 30 years. And it was on the top of that, on the back of that technological window, that the venture capital industry itself even grew from 150 people to 32,000. And that's the industry you're all familiar with now. There's 32,000 people who are now getting some sort of compensation for deploying capital into private tech companies. How do we know that? Well, we launched signal.nfx.com in 2018 as the place for the profiles for all the VCs. Now, that's an incredibly dramatic rise from 150 to 32,000, but you think as if it's permanent, but it's not. It wasn't always there, and it won't always be functioning this way.
Software, if you can sell it in volume, has extremely favorable economics. So we didn't have to build any factories. We were cash positive, and we didn't have a year where we lost money.
During Venture Capital 2.0, some of the bigger names like Sequoia and Andreessen and Benchmark and whatnot became household names. And then the founders also became household names, whether it's Bezos or Musk or Zuckerberg. This industry, propelled by software, became not only a place for building great products and great businesses, but it was incredible riches and a lot of status, a lot of media attention.
Bothered by all this publicity. You hate it, don't you?
Well, it became the talk of the town. It became talk of the world. The word startup was invented, which they hadn't even had before. The startup industrial complex came into being with all the media and the movies and the newsletters and the accelerators and the classes at Harvard Business School. The founder journey became the new Navy SEAL struggle. All this change has taken place over the last 30 years on the backs of software and the opportunity created by software. Venture Capital 2.0 turned into the American dream. But we're really at the phase of VC 3.0 because of AI. AI touches all industries, and VC with 32,000 people is now touching all industries, all enterprises, whether it's robotics or defense or climate or bio. We're applying the VC model and the VC thinking about how to scale and grow businesses to everything in the world now. And that wasn't the case 20 years ago. So VC is no longer just a cottage industry or a rising industry, but it's incredibly fast now. It's very precise. And at this moment, AI arrives and adds to the speed, adds to the depth, adds to the ability of these VC firms to look at more deals in more depth, faster and more effectively. Venture capital is becoming the ubiquitous way of building and scaling enterprises worldwide. We've identified at least 13 reasons why venture capital is going to continue to scale from 32,000 up to 60 and beyond in terms of people doing this job. The first thing is that the industry itself, the investing in, is still inefficient compared to other financial asset classes. So LPs will continue to get good returns, so they'll continue to invest. The second thing is that the asset class is still small. In a whole year, we raised, $200 billion? That's the size of one big hedge fund. It's still a tiny little industry, could easily double and no one would notice. Number three, more VCs are going to be needed because VC now applies to all industries. Number four is just international growth. It's been a big thing in the US, growing thing in Europe, but now it's going to be in Asia, in the Middle East, and Latin America. There's going to be more venture capital all over the world to satisfy the needs for economies to grow. Number five, LPs will continue to invest in venture capital because the LPs each have different strategies and different VCs have strategy and they match up. So every time you think that was a crazy investment that LP made, it probably wasn't from their perspective. Don't be too sure about what you think is a bad investment for an LP. Number six, LPs are going to continue to invest because venture firms have brands. That's not true with most investors. And so there's a flywheel that gets going with VC that's not true of other asset classes, and LPs know that. So if you've got a good brand, you're going to continue to get investment because LPs can bet on the brand. The seventh reason is LPs will continue to invest is because they don't have a lot of great alternatives. The returns in other asset classes have been coming down for the last 20 years as those asset classes get more and more efficient. And so the alpha available shrinks. Because VC is still inefficient, there's more alpha, there's more chance to beat the S&P 500. The eighth reason VC will continue to grow is because there's going to be new types of LPs. More people are learning about the VC asset class and are going to want to participate. And that's going to drive the asset class from 200 billion to 400 billion, which is like having a hoagie for the rest of the financial industry. More VCs are going to come into the industry because people like the job. You know, it's intellectually stimulating. You get to be the decider. It's more fun than being on the sell side of finance. You've got the optimism that your next bet is going to be the big one. So people like the job, and so it's going to continue to attract, 99th percentile talent into the job. Number 11, AI is going to make it easier for many people to be pretty good at the venture capital job of digging through data, analyzing and ranking companies for them to invest in. Number 12, there's just low barriers to entry. I tell people all the time, just start being a VC if you want to be a VC. Get a profile on Signal and just start making investments. There's not a lot of barrier to it. Number 13, VCs can be VCs part-time. So you might have a full-time job as a hedge fund manager or as a head of business development at a corporation or doing something else, but you can spend half your time, a third of your time investing capital on behalf of yourself or on behalf of the organization you work for. So you're actually going to see VCs popping up in lots of different organizations. And the last reason is just that, special communities will flourish. So if I'm in Detroit, I want more economic growth. So I, as a town, will set up some venture capitalists to look at business plans and make investments. If I'm a university, I will set up business plan competitions. You're seeing more and more this job of being a VC be necessary for every special community who wants to show that they care about economic development and growth. So software has been and will continue to be very special. As Venture Capital 3.0, we spread out into all the industries with the venture capital model and the startup model. We're going to start noticing how different businesses interact differently with the model. And you need to think as a founder, where am I? What industry am I in? And therefore, what is my best way of connecting with these new VCs who are now in this defense area, in this climate area? And it's going to be a new coming together, and each industry is going to have to require you as a founder and the investors to learn new methods that increase your probability of success. Okay, so if you look at the different attributes of what makes a business good or flourish or whatnot, we can see here why software was so special. And the venture capital model really depends on having one company out of 35 that gives them 100x. In all these industries, it's likely that the venture capital firms will be able to beat the S&P 500. But it does mean that the VCs are going to have to really work hard to make that happen. And they're going to have to figure out the formulas that work for them. So if you are a VC, prepare to grind and buckle up. So let's talk quickly about something called private equity. Private equity and venture capital are actually very similar, but they're different in important ways that affect you, the founder. As we move into this incumbency phase of the venture capital industry, into this 3.0, you will notice something, that the VCs are going to tend to start to get more sharp-elbowed. And this is a characteristic of more of a private equity firm. So private equity invests in established businesses whose business model is well understood, whose pricing is well understood, whose mechanisms are well understood, and then they crank down on those mechanisms. They load it up with debt, they fire more people, they optimize the workflow. The people are very fastidious, they're very precise, and they sort of take their piece of the pie. And that's how PE makes money. It's a very different mindset from a venture capitalist mindset, but very similar from the limited partners perspective, where the LPs invest in both of them, hoping to get outsized returns that beat the S&P 500 pretty significantly. There's going to be a culture clash between these two groups of people who are going after the same opportunities of applying AI to businesses, either old line businesses or new businesses. So just be aware that you might start feeling that over the next few years, over the next 10 years. AI is going to change everything about the VC world. So what does a VC do? They source deals, they analyze deals, they decide on what to invest in and win those deals, and then they support. So those are the 4 phases of a venture capital typically. The AI will be able to spot things earlier now, and VCs will be able to proactively reach out to you before you even knew you wanted to raise venture capital. Or maybe you've got a business and it just sold 3 customers in the last week. That might show up somewhere digitally. The AI will find it, alert the VC, again, an inbound call. So sourcing is going to become very different, and your experience of all this inbound from the VCs will go from a trickle a few years ago to a deluge over the next 10 years. That'll be a feature for you. The second thing for a VC, they're going to use AI to analyze. We still might only make 20 or 30 investments a year, but we're going to look at more and more companies because the AI is going to help us analyze more companies in more depth. Most VCs don't want to talk about the third phase, which is deciding. But increasingly, you've got to expect that VCs are going to be using algorithms and other signals to give them scores or indications of whether they should make the investment or not. And over the next 10, 15, 20 years, that will increase as a part of the decision-making process, and the people will sit around the table and say, hey, what does the algorithm say? And then the last phase of it is supporting. And this is a really good thing for founders because now the AI can be more attentive to everything you're doing. It can help you with getting connected to people that you might need in the moment. It'll help educate the investor as to what your needs might be. It might prep them before the board meetings. All sorts of things are possible with AI in getting VCs to support you more if you want it. And if you don't need it or want it, then they can also stand down on that. But that seems like a very positive area for how AI is going to impact VC and how it's going to help you. So as the VC industry gets bigger and accelerates, it's going to change how it feels to operate alongside of it as a founder. But the next 15 years are going to be amazing for startup development and for acceleration and growth. And it's your chance to go out and get it. It's never been a better time for you to start your company.